Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I am Jeff Barton, and this is The Mortgage Voice. Thanks very much for tuning in to the show, or at least doing a cruise by on your radio dial, driving around in the car. I know a lot of people listen to the show when they're off doing home errands or they're at some kind of religious ceremony on the weekends, on Sunday, Saturday. We like to think of ourselves as everybody's place to go when you're looking for help in trying to get a mortgage, you're trying to buy a house, you're trying to refinance. All of these things are exactly what we do, and you can find us pretty easily all the time if you miss the radio show on Saturday and Sunday on KCAA. If you go to YouTube, Jeff Barton, The Mortgage Voice, that is the show online on YouTube. We shoot the show for TV, so you can see me, hear me, and the guests on that particular program. We also have a great website, themortgagevoice.com, where you can not only see and hear the shows, but little bios of some of the guests that appear on a regular basis there. And if you want to contact them directly, you can. We have a number of other ways that you can participate in the show without actually a call-in. This is a recorded show. However, we do it weekly, so it is fresh. It is ready to go, and pretty soon you'll be able to take this advice or take this information and go to a mortgage broker or go to a real estate agent and get out there and find that great house that you want. Anyway, again, I'm Jeff Barton, and this is The Mortgage Voice. Okay, so lots of happening things in the news. Some of it affects mortgages, but a lot of it affects your psyche and what you want to do, whether you want to, continue your house purchase progress or not, and that depends usually on price. For a lot of people, anytime the rate on the mortgage goes up another point, it means another, million people can't afford it. So we've seen that rise substantially. Everybody knows it. This is old news. But we're now venturing up into going back up the ladder of the 6%. We've been up and down almost to 7, a little bit over 7, all the way down to 6 again. Now we're going back up again. This may be the place that we settle for a while. We've had some dire predictions of 8%, but that isn't yet. Although I do suggest if you're out there and you're on the fence of whether to buy or not, and you can afford that monthly payment, don't worry about the rate. Get in now. We probably will see a rate reduction, but not for a while. We are seeing go back and forth whether we're going to have a recession, whether we're going to let inflation continue unabated, although it has modulated a little bit down into the 6% range. And depending on what happens in March, we may see it actually come down a little bit more. The Fed continues to raise short-term interest rates. And again, remember, the Fed rate and the mortgage rate are not the same thing. So when people talk to you about the Fed is raising the rate, has nothing to do with your mortgage or the mortgage you want to get. Now, I say that, and yet it does have something to do with it in that the sentiment and the way that you calculate your particular way to afford a mortgage is going to depend on the bills you pay, whether it's your credit card or your student loan or your other signatory loans like a car loan. You don't place up collateral other than the car in the car loan. All of these are affected directly by the Fed interest rate, which will then, again, affect how much you can afford to pay your mortgage. So if your rate on credit cards goes up, it can't really go up anymore. Daryl, what is the rate on one of your credit cards, just off the top of your head?
Probably 12, 13%.
You're kidding.
They can go as high as 22, 23 sometimes.
Okay, that's excellent. That's a good card. A lot of rates, and anybody who's out there who has seen their rates rise a lot, could be 27 to 33%. And it really, again, depends on the usage of the card, who you are as a borrower, and obviously the card that you get. A lot of people who use airline cards, these cards are great if you can pay it off on a monthly, but if you let those continue, there's a reason they give you a lot of miles if you sign up for, Southwest Airlines credit card. The reason is because if you don't pay that credit card off, they're going to whack you with a bigger percentage than the one Daryl just quoted. And that, again, all of these costs affect how much you can afford in the mortgage. So tangentially, the Fed rate does affect your mortgage, but more on what you can afford rather than what the actual rate is. The rate that you are going to pay for your mortgage is based a lot on the bond market. The bond market, if you follow it, follow the 10-year, follow the 2-year. I just read an article today about the 2-year. So the 2-year, where is it? It's okay. So it's over 4% again. So for 2 years, tying your money up for 4%, not bad, right? Except inflation is 6%. But at the same time, if you're, have some savings or you have money socked away somewhere in the stock market, which is kind of flat, right? But you want to make sure that you're earning something so that there is some kind of income coming in. You're either going to buy yourself some corporate bonds or you're going to go and look at the 2-year treasuries. Now, treasuries sold to the public, there is obviously a limit. I think it's, I'm gonna screw this up, but I think it's close to $100,000 you got to invest. So if you're in that club, good for you. I'm not in that club, but you can get 2 years bundled with other people in funds that buy these kinds of bonds. But the 2-year at 4% is still a pretty good income for you. You put in $1 million, 4% a year, you're going to get $40,000 a year in interest. That's not bad. If you have that kind of money to invest, that's pretty good. And you would be able to continue to receive that money unabated through the term of the bond, which is 2 years. Now, the 10-year, another indicator of whatever your mortgage rate's going to be, the 10-year right now is at 3.55%. Historically, when this happens, the 2-year is paying more than the 10-year. We look towards a recession in the near future. Now, I've got, I don't know, what do we got here? We got 3 minutes left? Okay. I'm just going to talk about a couple of things within this scope of what we're talking about right now. Inflation, recession, bank failure, rate hike, mortgage rates, the Ukraine-Russian war, and COVID. These are the things driving the market. In any way that you look at it, they're all costing some kind of money to you, the person who has to figure out how you're going to get from A to B so that you have money left over to pay your mortgage at the end of each month or put a down payment and to get qualified for a mortgage. When you rate these things at home, which I'm sure anybody who is looking to buy a house or looking to get a mortgage is trying to figure out what are they afraid of most. Now, a lot of people who buy a house are afraid of the monthly payment. Why? Because, if you're talking recession or you're talking inflation or you're talking any of these things, you're worried that you're going to lose your job. Now, a lot of people in tech, a lot of people in finance, especially those 4 banks, you think anybody who works at those 4 banks is worried about their job? You know they are. All those people are stopped looking for houses because they don't know whether they got a job today or they're going to have a job tomorrow. But these issues that we talk about on a weekly basis are what people in the real world have to deal with when they're figuring out whether they're going to be able to afford a mortgage. That mortgage, based on the 10-year, and that 10 years at 3.55%, it's usually a percentage or a margin above that the mortgage interest rates are. Now, we've got mortgage interest rates. The 30 years at 6.6. The 15 is at 6.0. The FHA is at 6.05. Jumbo is at 5.95 and 6.60 for the 5/1 ARM. These are the rates. Now, that's the national average. It's not a specific rate. You might be able to get a better rate if you got great credit and you got a lot of money down and you have a good deal of your money socked away in the bank that you're going to get the loan, i.e. Wells Fargo, Bank of America, Chase Manhattan, blah, 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 all that kind of stuff. For me, this would be a time to really make sure that you're prepared to purchase by figuring out your stress level and your, need to feel good that your long-term prognosis on keeping the job and paying the mortgage is good. You need a professional to do that. You need a non-affiliated professional, somebody who is has your best interest at heart and who can also explain their way through, the minefield of mortgage shopping. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Appreciate you listening. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. You can hear and listen to this show in a number of different ways. We have a great website. We have, obviously, KCAA, the radio station, which we air on Saturday and Sunday each week. And we have the podcast. And did you get the Daryl from Fred, the new 2 podcasting, Apple?
No, better look it up.
Yeah, it's excellent. Yeah, so we're all over the place. Anyway, Daryl has a number of these that you can listen to, and it's right here.
Without Fred.
Without Fred.
We've got Apple Podcasts. We've got Google Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, and also podclips.io.
Podclips.io, great place where you can centralize all your podcasting wants and needs. Go there. You can see family, lifestyle. You can hear me in the financial section. There's a health section. A number of different excellent and qualified people who can just chat your ear off, entertain you, and give you some good information. Go to podclips.io. Okay, I'm Jeff Barton. This is The Mortgage Voice. Again, thanks very much for calling. We've been talking on the show a number of different topics that have to do with how you as the consumer, you're out there, you're trying to figure out how to get into this house that you want to buy. Prices have cooled somewhat, although we are yet to see the spring buying season. Now, whether it comes to full fruition or not, we usually see an uptick in the number of listings on the market starting about right now. I mean, we're at the end of March. Spring has sprung, although speaking of spring has sprung, it sprung a leak, really. It's been raining so much in Southern California. And of course, our wonderful governor. By the way, water issues are a huge issue when you're buying your house. You want to buy a house, obviously, in a place where the municipality or whoever controls your water has it. And now down in San Diego, obviously, you're making your own water, which is a tremendous asset to those who are buying a house down in that area. But in the rest of California, we rely upon either the local reservoirs, the reservoir system here in California, Colorado River even so much. This year, obviously, everybody knows we have plenty of water, yet they still won't release the it's a drought label on us. Now, I don't know whether there's money involved or whether there's some kind of surcharge that they charge you for using too much water so that there's I just don't figure out what's the difference between where we are now and where we're supposed to be if there is no drought. And I mean, what does it look like? Because my backyard looks like a lake. I don't know about your backyard, but in many parts of California, if you're in the mountain right now, it's over 200% of what their normal snowfall is in a normal year. Average snowfall in an average year is, let's say, 100 inches. So they have 200 inches of snow and all over. And one cool thing about driving around in the San Bernardino Riverside areas is that normally in the summer, in certain months of the year, even years, you don't see snow up in the mountains. It's really cool. Now, I've been to Utah, I've been to Montana, I've been to a number of states where they have mountains, I mean real mountains, and snow really exists almost through July and August. Well, here in Southern California, San Bernardino Riverside counties, a little bit of Los Angeles, certainly that the show reaches Orange County and out in Palm Springs, the snow-capped mountains are great, and you're driving down the road and you look up and you go, wow, that's great. Well, anyway, that snow obviously melts during the summer slowly, and that's what keeps our aquifers as well as the rivers and streams and everything else that we need for water usage full. This year, for some reason, as I said, the governor does not wish to be able to say, but does not say, hey, the drought's over. Reading an article on it, just not sure where all of that reaches. He said actually that we are not out of drought-stricken areas, but if, as I said, you're in a neighborhood, in a town, in a city, which is water dependent on one or only one source. I'm thinking, of course, about Las Vegas, Nevada. If they don't have Lake Mead full, they don't have water from anywhere. Now, I spoke to somebody about the real estate market out there. We've had many people on the show who talk about Las Vegas real estate, so I won't belabor that point. But water, to me, is always at the center of that city's growth, whether that city's growth is going to continue, I said that word again, unabated, meaning it's just going to willy-nilly go until they stop having wood to build houses or whatever they build their houses with. No, water is the issue. Water is the issue there. It's the issue here in Southern California, even though, in my mind, we have plenty of it. Okay, let's get right to the 4 bank failures that we've seen and how that really affects not only your psyche, but it could affect your wallet if, in fact, that spreads to a larger group of banks which are more depository institutions. The 4 banks, of course, being Silicon Valley Bank, Signature, Credit Suisse, which is not necessarily a U.S. bank, but that's a Swiss bank. But we do have plenty of connections to Credit Suisse there and here in the U.S. And First Republic Bank, which they've been trying to save for, I don't know, any 2-3 weeks. Now, when we first heard about Silicon Valley Bank, it was the second largest bank failure in U.S. history. The third largest was Signature Bank. Now, they are Silicon Valley based, one of them, obviously. Silicon Valley Bank is Silicon Valley, so that's a lot of venture capital, things like that. The crypto bank is Signature Bank. First Republic had a lot of different types of investments. All of them got caught up when interest rates rose. They were in investments which obviously carried some risk. If interest rates did rise, they did rise, and all these banks went out of business. So what has been done and what is continuing to be done in order to safeguard your dollar in your savings account in your bank? Because everybody knows when you go to buy a house or when you're trying to rent something, you have to prove that you have assets and reserves qualify for that loan or get that particular lease or rental. And usually, I don't know, it's anywhere from 3 to 6 months in terms of reserves in order to get that. Well, if you're worried about your bank and whether they're solvent or not, a lot of the major banks, now we're talking, what are the major banks? I think there's 5, maybe 10 of them. The requirement that they have a certain amount of money on hand on a daily, which is why the Fed rate even exists, because all these banks don't have that, so they have to borrow money at the overnight window at the Fed in order to meet the financial requirements that Dodd-Frank put in place on them in the depository. All these depository institutions like Chase, Bank of America, Wells Fargo, and the like, they have these requirements because the depositors have to know if all the depositors show up on one day and they want to take all their money out, which is what happened at Silicon Valley Bank, that isn't going to put the bank out of business. So all of these requirements and what they want to have done, some for smaller banks like Silicon Valley Bank, $160 billion in assets, they call that a smaller bank. Okay, whatever, I don't know. But during the Trump administration, the last 2 years, they removed some of the requirements for the amount of money you had to have to back up whatever the deposits they put in. So most people get deposits in the door, and then they basically go out there and invest, and those investments will make money, which is a hedge against losses from whatever the run might be on the bank, but they didn't have the required amount of money because they didn't have to anymore. The actual requirements were removed during the last couple of years of the Trump administration. Now, I don't blame anybody politically because there is no reason or, the next administration, Biden could have come in and said, you know what, we're going to put those requirements back in place. This political game about who was at fault, let's blame somebody, is ridiculous. If you believe that the requirements by Dodd-Frank should still be in place, then you should have done that as soon as you moved into the office, because this is not an unusual circumstance. We saw it at Lincoln Savings back in the 80s. We saw the dot-com bubble burst and a bunch of those banks go under. We saw during the financial crisis of 2008, 300-400 banks go under, and now we're seeing banks go under again. And it all has to do with the required amount of money that you need to keep in your vault or somewhere whereby you can cover losses if there's a run on the bank. And a run on the bank means you go there to get your money out because you don't trust that they're going to be able to keep it. That is what's happening. Just quickly, First Citizens Bank bought $72 billion worth of assets from Silicon Valley Bank. The rest of it is held in trust, and it's been discounted by $16.5 billion in order to get somebody to step up, and take the responsibility of not only their loans, but of the depositors as well. Good deal maybe for First Citizens? Yeah, they're thinking so. And then, as I said, $90 billion remain in receivership. And I think 90 and 70, that's 160. Right, that's exactly what it is. Anyway, we're up against it. Sorry, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. You know, I say that each and every segment, and I actually mean it. The reason is there's not a lot of programs out there that talks about housing, mortgages, and your part in all of it, whether it's from the news that you hear out there, from the stresses that life brings upon you as a result of that, or it's very specifically about what is the loan product that I can afford. All of these things are what we do on a weekly basis and have been doing it for 9+ years. Hundreds and hundreds of shows on YouTube, Jeff Barton, the Mortgage Voice. Go there and you can catch up or just catch the daily. We try to do a daily, at least once, twice a week on Instagram or Facebook or LinkedIn or some of the other social media channels, just so that we can keep our message of, look, these things are available out there and you are in control. People who try to sell you or push you in a direction, you need information. This is the one place that I know of for free. You can tune in once a week for an hour and just hear us talk about mortgages as if you were a fly on the wall in a living room at a cocktail party where a bunch of mortgage people are talking about mortgages. Anyway, I'm Jeff Barton, and joining us once again, I haven't had Ed Peisner on the show in quite some time, but I'm very excited to have him back, is Ed Peisner. He's the Organization for Social Media Safety. Ed joins us now. Ed, how are you?
I'm doing well, Jeff. How are you?
I'm great, thank you, Ed, and thank you very much. Your enthusiasm and the way that you portray what you're doing in many different areas that I look at, whether it's social media, online, or directly to your website, is awesome. How is that particular thing going for you?
You know what, Jeff? Thank you so much. Always thank you for having me on the show.
Sure.
You know, it's going great. It has, obviously, the pandemic sort of, I think, slowed everybody up over the last couple of years. But now that all schools are back in session, we have been called by school districts all over the United States to come and present our curriculum and our workshop to students, parents, educators all over the country. And it's just taking off. You know, right now it's April. I'm actually in Northern California talking to a certain school district for the next couple of weeks. I've been all over the country this whole semester to the point where we're already booking into next semester already.
Wow.
So it's grown exponentially.
Okay, so when you first started this, it grew out of your obvious tragedy that happened to your son, Jordan. How's he doing?
Mm-hmm. Jordan's doing okay. Jordan suffered, for those that are listening and never heard the story, this is now 6 years ago.
Right.
Jordan suffered a brain injury from a social media motivated attack, which was filmed and put up on social media where everybody viewed it. And that what we do now is sort of born from that one moment.
Right.
There was nothing I could do about his brain injury, but there was something I could do about the social media piece where they filmed it and everybody watched it. So today, 6 years later, Jordan's doing better. You know, a brain injury lasts for the rest of your life. It's
Right.
not like a broken arm that heals and you're fine. So we have the things we deal with as a family. Other than that, we have turned our mess into a message. Just so you know, last year, I don't know if you saw it or not on social media, we were awarded as Nonprofit of the Year in California last year.
Oh, congratulations. Nice. I didn't know that.
Yeah, thank you. Yeah, that was very nice.
Yep.
And, we're just trying to get out there and educate kids about social media safety tools that they could use and educate the parents about how to react to things that might be happening on social media, because we're just seeing a rise in things like cyberbullying and
Sure.
hate speech and things like that.
No, I think a lot of people get activated when they get online, and I think there's no filter that they have personally, especially if they're raised in the age whereby the phone is like stuck to your hand, and access to any kind of information about anything is a click away. It really hasn't allowed us as a society to catch up and to try to figure out what's the best way to do this, especially at a younger age. So, what's the message you bring to both kids and to adults?
Well, if I were to break it down into three pieces, it's to block and report any content that comes across your social media platforms that might be dangerous, cyberbullying content. When a child comes across something that might be hate-filled or hate speech, they should block it and then report it to the platforms so the platforms could take it down. That's number one. Also, you want our kids and adults, too. We want to be upstanders and not bystanders.
Right.
We don't want to just keep watching things happen and absorb it. The last thing would be what we call the STEP process, and this goes for adults, too. Before we post or comment or message somebody, we should follow the process called STEP. It stands for stop and take a breath, think about your words, empathize, and then post. So that little process that I teach the kids, stop, think, empathize, and post, could actually help bring down instances of cyberbullying. Because we're not thinking. We're acting very quickly. We see a post or we see something on social media and we just comment as fast as possible without really giving it a second thought. But we need to realize that sometimes those words or that comment could do harm to the other person.
I like the anachronism. What is it again?
Well, it's the STEP process. Stop, think, empathize, post.
STEP process. No, I like that very much, and I absolutely agree with the message. I think, I've been to 400 years of therapy, and a lot of the therapy that I've been to talks about slowing the process down. Whatever is the immediacy of the impulse to act needs to be interrupted so that you do have a chance to be able to think. As you say, you stop, you think,
Absolutely.
you empathize, you post. That's great, and I think that
Thank you.
doing that will really help people, maybe just think a little bit more. I mean, I know I don't know what the mechanics are, but I do know in my own life it works really well.
Yeah, it's real important that we slow down, just like you said. We live in a fast-paced world today. Everything's at our fingertips.
Yep.
Sometimes we're posting things and without thought behind it. We just react very quickly. So we really need to slow down and think.
I agree. This is Ed Peisner for everybody listening, the Organization for Social Media Safety. Ed's been on the show many times in the past, and we haven't had him on for a while. I wanted to get caught up on what's happening. He tells us that the organization itself is the California Nonprofit of the Year last year, which is a big deal. California probably hosts 50% of the nonprofits nationally anyway. So this is pretty good. Now, you have an event coming up and a way by which people can donate or get involved. How do they do that?
Yeah, so obviously you could always go to our website, socialmediasafety.org. If anybody's in the Los Angeles area, on May 10th, we're having our second annual Social Media Safety Gala. It's at the Beverly Hilton in Beverly Hills. You could go online to socialmediasafety.org and find out more information about it. If they want to attend, they could buy tickets to it. There'll be some celebrities. There's just a lot of wonderful people that show up to support the cause. Last year, it was over 310 people showed up, so it was a sellout. If you can't make it, you're not in the area, you want to just go onto our website and make a donation. Any donation, $1 helps us. So any donation, large or small. If you know anybody that might want to sponsor the gala, we always look for sponsorships and things like that. This all began from a tragedy. We've tried to turn the mess into a message, and we're growing grassroots. This is all about networking.
I know that politically there's very strong support for regulating a lot of what goes on the big platforms, Meta and LinkedIn and a number of these others, certainly TikTok. How has this helped the cause?
Well, we did have a law passed in 2018 called Jordan's Law, named after my son, for the filming of a violent act. which could hold you accountable for that. There's also other legislation right now that we have either drafted or acknowledged and signed on and approved. We're trying to keep kids and adults safe on social media. It does need to be regulated at some level.
Right.
Right now, unfortunately, social media and technology is moving at light speed, and as we all know, the legal system moves at a snail's pace.
Right.
So we're trying to catch up. But if you just think about these children that are in 5th grade and 4th grade, that are 9 and 10 years old, that have access in the palm of their hand to all the hate and the ugliness and all the bad stuff that we see, we need to regulate that. We need to make sure their brains are protected from this hate.
I totally agree with you. And unfortunately, we're up against it right now. I want to have you back sooner than, all this time that goes by, just to give us an idea of what you're doing in the future. But I really appreciate you coming on once again and really informing and educating.
You got it, Jeff. Great to hear your voice and
I know.
talk to you again.
I know, it's great, really good. I talked to Dr. Bertoli, not too long ago. She was on the show, too. So, old friends, I really appreciate you coming on.
You got it, Jeff. Take care of yourself. Be well.
And you, too. That's Ed Peisner for everybody, the Organization for Social Media Safety. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. I always say your voice in the mortgage industry because you need some advocate out there, somebody who's going to pitch for you, somebody who's going to look out for your interests. I know that sounds like some sales pitch, but it is real, and you have to find a person or persons that can help you through the maze, which is the loan process. It is not simple, and I've been in the business a long time, so for me to look at something, to see a solution, and to be able to put forth a path to get there is pretty second nature. But for most people who do this once a lifetime, maybe twice, it is not simple, it is not intuitive, and you need to know that the documentation, the trust in the individuals, these things that you sign, the things that are signed on your behalf, i.e. the loan estimate that you send back with your signature on it, then gets sent to the lender, and then we can generate documents out there to begin the process. All of this is overwhelming. To talk about some of the reasons why, talking to not only she, but to many a good professional out there is Brenda Scott from Malibu Funding, who joins us now. Brenda, how are you?
I'm good. How you doing?
I'm okay. Thank you very much, and thanks for asking. Beautiful day out there in the neighborhood.
It is. But, I wanted to just, before I forget, because I think the older I get, I just start forgetting things like rapidly.
Uh-huh.
But you made a comment, and I wanted to just elaborate on that. You do need someone that is advocating for you.
Right.
Because it is so much material out there, and it's so many different programs right now. You really need someone that is working on your behalf to get what you want and satisfy your need in the real estate industry. And I might add again, the lenders are like doing everything they can to get the borrower what they want and not just give them anything at this point.
Yeah, I agree with that. And I think based on experience, this is the other reason why during the pandemic, when the butcher and the candlestick maker and everybody jumped in, as they always do when it's easy, it's the times that are tough, like now when we're looking to 6 to 7% interest rates, maybe higher. If you're going non-QM, certainly higher. Hard money, certainly higher than that. You need somebody who's not only looking at the rate, but also looking at what are you trying to do and how can we best get there.
Right, and it's long term. I assume when you buying your first home or you're refinancing, and there's needs that come up all the time. We don't know what the needs are, but you may need to get that cash. You may need to refinance, but still, even if you refinance at that higher rate, hold it for a year. And God bless us, if this market, when this market's going to turn, because you and
Always
I both
does.
know it's going to turn.
Yep.
Now you can refinance it and get that lower rate.
Yeah. Okay. Let's talk rate for a second. When rate is not the issue, what is the major issue? Is it qualifying for the loan? Is it documentation? What?
Oh yeah, it's qualifying. Even now, even with rates being as high as they are, it's still kind of tough qualifying. You just
Right.
got to make sure you get all of your documents up front. I think the worst thing in the world that you can do is to submit a loan and have the underwriter, condition you with 20,000 conditions versus getting everything in at the same time. Get everything in at once. Now you're in a position to say, okay, now Brenda, what's my options?
Right. No, I think those are really good observations because, in a market like this, a lot of buyers will say, will turn to you as the loan officer and ask you, why is this taking so long? What's going on? Well, unknown to a lot of borrowers is that there are constraints on lenders too. And a lot of
Oh,
times,
for sure.
whatever's funding that loan beyond the lender that's actually got their name on the documents may have changed during the 30 to 60 days that you're trying to get the loan.
Right, right. And it's so many compliance.
Right.
You got to make sure you cross your T's, dot
Yep.
your I's. I mean, I have times where I have to go back and say, I need you to sign this disclosures. I got to have it signed before they can move the docs.
Right.
I mean, when you go to loan docs, you basically have to be ready to close. So we want to make sure we get all the disclosures signed. We want to make sure all the conditions are in. And even with the conditions, lenders may ask for a lot of conditions, but they are really negotiable conditions. If you can't get me, 12 months bank statements or 2 months bank statements, you can get me something else. So they're being creative in their conditions as well, of not they're wanting to close that loan. So, okay, if you can't get me that, get me this, and that'll work for me too.
Okay, when submitting a loan, when trying to figure out you and the borrower what is the best situation for them, documentation, just to start off the loan, what do they need? What does somebody have to give you in order to say, okay, from this I can get an estimate on what the costs are?
W-2s, current pay stubs, and the first year of your taxes.
That's it?
That's all I need.
Okay, and go ahead.
With your W-2s, if you're refinancing, of course, a copy of your mortgage statement to show, what mortgage you have or what kind of mortgage you have. But just the rent and the credit report. You do need a credit report. That's your one thing, because your pricing and your rate is going to be based, one, on your FICO score. So if you have a low FICO score, then that's a different price. And if you have, you can have up to an 800 FICO score, and you still are going to be subject to that higher rate, but you may be a little lack in some of the conditions that they ask for.
I see. Okay, let's talk a little bit cost. Now, there are some ticky-tack costs which have really doubled, tripled, quadrupled over the last 2 or 3 years. You mentioned credit report. Let's talk about that. What's your typical credit report going to cost for a single borrower?
$60.
Okay, that's
and I tell you why. Because you have to run the credit report, and there's another report we have to get. It's called a lien and judgment.
Okay.
So that means when they run your credit report, they give me my FICO score because that's number uno. But then they also run what they call a lien and judgment, and that's going to be based on your date of birth and your Social Security. So that's an additional cost. It's not very much, but it can cost you $4 or $5, sometimes up to $10 to get that report.
Now, during the process itself, how many times does that credit report run?
Once. We only run it one time. We only run it, and I really try and stretch that one, because I have a borrower now that we've just been waiting for the best interest rate for them. So I'm still dealing with a credit report that was pulled in at the end of December, and the lender is accepting it.
Okay, that's good. No, that's very good, because I know based on running a company for a number of years, credit report is always something that is one of those fees where it just annoys the borrower. Why do I have to pay this? Why don't you pay this? And how do we answer that when a borrower is reluctant to do that?
Well, I don't know. Maybe I shouldn't say it, but sometimes, if it's a borrower that I've done business from before and we've had, previous experience, I'll just go ahead and pull the credit report.
Right.
But, sometimes you just you take a risk. I mean, I can run the credit report and never hear from them again.
Right. You pay for the credit report. Right. I
is
get it.
That credit report is given to you once you pay for it. So
Right.
if you're not happy with Malibu, which I know you're not going to be, but you have access to that credit report, and you can use that credit report if you choose to shop. They still would have to run a credit report on you because it has to be under that broker's name. But at least that's your credit report that you
Right.
keep for yourself.
Yeah, so the ownership of the credit report itself is always the customers, right? Even though there's
Always the customer.
always the customers.
Always the customer.
Okay, so we have about a minute left. I want to give you an opportunity to be able to shout out how people can get in touch with a very knowledgeable, experienced loan officer who can actually give you a number of different options. Do that if you can, please.
Yes. Call me. I'm waiting for you. It's 562-500-2400. Brenda Scott.
Excellent. This is Brenda Scott. She is a loan officer for Malibu Funding. Brenda, thanks very much for coming on the show.
Thank you. Have a good day.
And you too.
Stay safe.
Yes, exactly. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Good morning, good afternoon. How's everybody doing out there? This is Jeff Barton. This is The Mortgage Voice, and thanks very much for tuning in to the show or just listening on your way home from wherever you are. A lot of people listen to the show. They go to Home Depot, they buy something, they want to fix their house up, or they're looking in the paper to see if there are any good rentals out there. The best place to obviously look for rental is through the MLS, the multiple listing service. You need an agent to do that. There are certainly plenty of websites that you can go to, but if you want the greatest and fullest spread of affordable homes, the MLS is the way to go. However, the paper, like I just mentioned, a lot of people don't know that, but the classifieds always carry rentals, as do the For Rent by Owner website and a number of other things. The reason I bring up rentals is because in some cities, rentals themselves have fallen. And what I mean by that is that they have decreased the cost that you will be paying. Now, during COVID, we saw rentals, and there's a number of reasons for that. The major reason is that housing has been short the whole time, and people want to be able to own a house, but they can't, so they rent. And when people were trying to get out of the big cities because of COVID and go work from some remote place, really drove rents in these COVID cities, and that means the city away from the central core of where they were actually living, higher, a lot higher than had previously been, really locking out the owners from renting to local people. Okay, so let's just talk about a good news of this is that rents have fallen. And where have they fallen? Okay, now some of these cities are not maybe where you want to live, but it does give you an idea of what the market trend is. And again, it's mixed. So I'll just give you the top 5. Minnesota. Minneapolis, St. Paul, Minnesota, rents are down 3.5%. Phoenix, Arizona, down 4%. New Orleans, 6.36% down. Austin, Texas, great place, by the way, down 6.5%. And Oklahoma City is down the most at 15.71%. Now, obviously, the run-up of these rents in these cities occurred during the COVID escape, I guess, is what the best way to say it. The year over year, however, and that means, let's say, and this is a January to January index, it's looking at the rents year over year nationwide are up 1.7%. Now, during COVID, as I said, rents really skyrocketed. And when they started to worry about inflation, when those inflation numbers looked terrible, one of the main components of inflation, when they calculate it, is housing. And as we all know, the price of a home, the price of rental, the price of a new car, and the price of a used car, which all make up about 40% of the index of inflation, were all up big. I mean, really big, like double, triple what they were. And that's what really drove that 9.5% inflation for, 4 to 6 months. Now that those things have reversed, we see inflation now around 6, and we will probably see it continue to fall, probably not aggressively, but continue to fall. Now, I know anybody who's out there and is saying, what are you talking about? I buy groceries every week. Things are up all the time. It brings me to a quick opinion. I think if you can raise prices to make more money, it not necessarily means that that's driven by costs. It's usually driven by, hey, here's an opportunity to make more money. Now, I see that in small stores. I see that in big commodities. We talked, I think, last week about the electric bill and the gas bill and how those have fluctuated hugely across the U.S., whether it's spiking at a certain month because it's cold or they don't have the amount of natural gas that they need. All of this stuff drives me absolutely insane. Now, I'm not saying that there's controls that need to be or should be, but I'm just saying, do people always have to look to the buck first instead of their neighbor first? Anyway, enough of the opinion. Okay. Moody's says growth on rents will be in 2023 2 to 3%. Okay, so that's not so bad. That really is usually what's built into each and every contract. When you rent, anybody who's rented out there will know there's an escalator clause in the contract if you want to renew. So whether it's 5%, 10%, but usually in some places it's regulated. It's 2 to 3%. That's what it's regulated. And okay. So one of the reasons that in these 5 cities that the rent is de-escalating is because the new rental units that were built over the last 3 to 5 years there's a lot of them, and especially in these areas. And the greatest, what it said in the article I read was, it's the greatest amount of new rental properties on the market in 50 years. Now, 50 years to me used to sound like, I can't even imagine that. I mean, when I was born, 50 years before it was, they didn't even have cars. Okay, so today, if you say 50 years, I'm thinking, that's like yesterday. I was a senior in high school 50 years ago, or whatever it was. I was in college, So the 50-year mark doesn't seem like a lot to me, but to most people, it really does. So 50 years, the most rental units being built in 2022, that's a big deal. Now, in regards to home prices, as opposed to rentals, this is home prices. There are a number of cities where home prices have also fallen, and I'll give you the top 5. Couple of them are in California. So here we go. San Diego, 1.4%, it fell. Portland, 0.5 point. Seattle, 5.1%, and San Francisco down 7.6%. Now, you may say, wow, it's down 7.6%. But in San Francisco, I think the median home price probably sells for about $1 million, $1.5 million. There is no cheap in San Francisco. So if it falls by $7-8 grand or whatever it is, 20, 30,000, is it really going to be something that's going to move the needle in my mind in terms of going to buy a house? No, it's not. Now, some of the places where we have seen the exact opposite, i.e. prices have risen. This is why I said the housing market is a little fickle, because some places housing is doing better than other places. But in general, what we see is this fluctuation all across the board. So 3 cities in predominantly in the South are we're seeing a lot of, and by the way, I went to one of these cities last weekend. It's Atlanta, Georgia. The home prices are up 8.4% from a year earlier. Atlanta is booming. Anybody who hasn't been there, now we usually have, who do we have from there that comes on the show?
Brenda.
Yeah, whoever it is. Sorry about that. That was a big on the show. Not great, but
Bradbury.
Yeah, no, you got it right. I just can't remember her name right now off the top of my head. Anyway, Atlanta's a great city.
Bradford.
Yes, the Bradford Group. Exactly. Very good. Nice. Look at the mind like a steel trap. That's the way we used to say it. I've never seen a steel trap, but that's how quickly it closed. It's just boom right there. So Atlanta up 8.4%. As I said, great city, great place to live, and they're building like cranes everywhere. Okay, the second city, Tampa Bay, Florida, the prices are up 10.5%. Now, Miami is the first one, up 13.8%. Florida is booming. Now, there's a lot of reasons for Florida booming, and there's a lot of reasons why people like Florida. Aside from the governor, aside from politics, they don't have state income tax. That's the number one reason, and it's warm. So if you're on the East Coast in, Boston or Providence or New Haven or one of these places where it's just awful in the winter, all the time, cold, 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 you're thinking, how do I get out of this? In the 60s, when I was a kid, we went to Florida maybe once every 1 or 2 years. Now, we were well off. In those days, $30,000 a year was a big salary, and that's what my dad made. And we could jump on a plane, I don't know, for $40-50. There were 6 of us, or 8 of us, or how many it was, and fly down to Florida, get down to the Keys. And I don't know what we paid for rent, but Florida was just awesome, and I loved it at that time. Now, over the years, it's had its issue, and obviously they've got hurricane season. But if it's cold and you're in the Northeast, and there's a tax, no state income tax, and you're making above $200,000, that's a significant savings if you have your residence in Florida. So a lot of people who move to Florida do it for that reason. Now, there's a couple other states. Texas is one of them, absolutely. And what's the other one? I can't remember. Anyway, Texas is another state that doesn't have a state income tax. I think it's South Dakota or something like that. There are more, but when you have that as an attraction to a person making a good salary, there's huge incentive. Oh, we're up against it. Wow, that's hard. Okay. Anyway, I'm Jeff Barton. I really appreciate you listening to the show each and every week. We bring to you best we can, and we've done it again this week. We'll see you next time. And again, this is Jeff Barton for The Mortgage Voice.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.